This video is all about liquidity. This is going to be part one of a two-part series on liquidity. So if you want to know where the money is and how to trade towards the money, you're definitely in the right place. So let's get into the video. So like I said, this is going to be a two-part series on liquidity. So you guys know we always trade towards the money. It's all about the money on this channel. So the first thing to do is to define what liquidity means first, actually. Liquidity just means money, okay? It's money in the markets, where the money is in the markets, and that's it. So that's all liquidity means. So whenever someone says trading towards liquidity, or whenever you hear me talking about trading towards liquidity, I'm talking about trading towards the money, first of all. And then some of you guys are probably thinking, so what on earth is this money thing? You know, what is this money thing? What's this money we're talking about right now? So the money is people's stop losses, because, you know, when they get taken out of the trade, they lose money. So liquidity just means money. So where the money is in the markets. So that's the first thing we're going to do today. We're going to identify where the money is in the market. This is like the really basic level of liquidity. Beginners can understand this. Everyone can understand this. And I'm going to break this down so beginners can even understand this too. So how to identify liquidity, and I've got a few things drawn up for you first, and then I'm going to take you to the charts to show you examples of these things. So as you can see right here, so this is the first example I have for you guys. So just imagine this for now. So the arrows pointing down are the sell candles, and the arrows pointing up are the buy candles. And so right now you can see that there's a low. Down here, there's a high, there's another low, and there's another high. So you have to remember something. There's going to be liquidity on both sides of the market. There's going to be liquidity on the bottom side and on the top side. There's liquidity all over the market. There's obviously going to be major liquidity, and there's going to be some minor liquidity too. Major liquidity just basically means it's the liquidity on the higher time frames. And when it comes to that internal liquidity, it just means liquidity on the lower time frames. We've got a low, we got a high, we got a low, we got a high. There's going to be money beneath here. There's going to be money beneath here. And I'm just going to use the pound side. You know, I'm from the UK, so we just use the pound sign for now. So there's going to be money beneath here. Why? Because when people are buying up, where they're putting a stop loss beneath this low, okay? Or beneath another low down here. So there's going to be money down here. There's going to be stop losses down here. There's going to be liquidity over here. And once again, the people who sold down, let's just say this was another high, for example, let's just say this was another high. The people who sold down, they're going to have stop losses above here. So we're going to put a money sign up here too, because there's a money sign. There's money in these markets. There's monies on both sides of the markets. And this can be on any single time frame, the 1 minute time frame, the daily time frame, the monthly time frame. It doesn't really matter about the time frame it's on. It's more so whenever you see a high, there's going to be money up there. Whenever you see a low, there's also going to be money there too. Like I said, this is the real entry level, basic level of liquidity right now. Okay, so let me just move this up a little bit so you guys can see a bit better. So now you can see there's money, there's going to be money on both sides. And so what happens is when price trades higher, takes the money on the top side and returns back down, people look to enter for buys. They're normally putting their stop loss beneath the lows, okay, beneath the lows. So there's going to be money beneath these lows. And so now, okay, this is just a higher high and a higher low example. This is a lower low and a lower high example. And so when it comes to this level over here, I just want to quickly mark up this level over here. There's going to be stop losses above this area. Just like there was stop losses above this area, there's going to be stop losses above here. And what happens is this then becomes buy side liquidity. You have to think about who's looking to buy up here. So let's just break it down one more time. I know we're spending a bit of time on this. As long as you can get this part of the liquidity series on lock, then, you know, the rest of it should be a breeze. You have to think about what kind of money is above this level here. What kind of money is above here? So first of all, you're going to have people looking to sell. Yeah, they're going to put their stop losses up here. They're going to put their stop losses up here. So we're just going to put people looking to sell. Sellers. I'm just going to put sellers over here. Let's quickly adjust this real quick. Let's make it a 16. There we go. So there's going to be sellers stop losses up here. Who else has money up here? There's also going to be buyers out here. So the reason I say there's going to be buyers out here, because some people do breakout buying. They do breakout trading. You know, oh, if it breaks out of the zone, I'm buying. And so what would normally happen is when price trades up past their zone, they look to get in for an entry and they put their stop loss somewhere within this low, either the low or within this whole push up. So we also have, who else? We also have breakout sellers, breakout buyers in this case, breakout buyers. There we go. Can't type today. There we go. Sweet, lovely. So we have breakout buyers, yeah? So there's going to be money up here, because what would happen is if price tagged them in and then trade it back down, they also get stopped out. So we're going to have breakout buyers in this case, or, you know, people that do breakout buying. So we have people selling. We also have people who are doing breakout buying here. And so in other words, there's money up here. You have to always be thinking about where the stop loss is. And so there's going to be stop losses beneath this low as well. These are going to be the people who are doing, who are buying, first of all. These are the buyers, yeah? And then people doing breakout selling. So breakout selling, and it doesn't really matter what time frame you're on, you know, it's the same thing throughout the whole time frame. And it's going to be the same thing over here. The people looking to sell from this area here, they're going to put their stop loss above a previous low, for example, above a previous low. So we're going to just copy and paste this real quick and just put it here. And then these are the sellers. Sellers are going to have their stop loss over here, and the people who are looking to do breakout buyers, yeah, like that, breakout buyers. There we go. Down here is going to be over here now. I've added a line. There we go. So this is going to be people looking to buy. Their stop loss is going to be beneath this low, buyers, and then we have people doing breakout selling. Okay, breakout selling. There we go. Sweet, lovely. What I'm trying to just show you guys first of all is that there's liquidity on both sides of the market. There's liquidity on both sides of the market. That's the main thing for you to understand first of all. So there's going to be money above and beneath these highs and lows. These highs and lows, there's going to be money above these highs and lows. Let me quickly just put this here as well. There we go. Every single time price pulls back and expands, there's going to be money on each swing point. Now I'm going to show you another example of where the money is. Okay, so here's another example of liquidity again. So this time we have equal highs and equal lows. So first of all, equal highs, these are just when price returns back to the same or roughly about the same kind of area more than once. If it comes back 2 times, it's equal highs. If it comes back 3 times, it's triple highs. And so what's up here once again? There's going to be money above these equal highs, because what happens is this is used as a strong retail confirmation. It's known as a double top. It's known as equal highs. And so what would happen is when price returns back to the same area, it becomes equal highs. What traders who trade retail concepts are trained to do is whenever price returns back to this area twice and there's a little small rejection, they're trained or they're taught to sell price down, sell the market down. And so you have to think about what's happening here. If this is what they're being trained to do, where are they looking to put their stop loss? They're looking to put their stop loss somewhere within this high over here. Sometimes, you know, you might get the people who do, who are really zealous, and what they will do is they'll put their stop loss right at the high. Other people will put their stop loss probably within 10 to 30 pips of this high, or the previous high above these equal highs. So in other words, there's going to be money up here again. There's going to be money up here because this is where the money is. This is where their stop losses, and stop losses equal money. So there's going to be some buy side liquidity up here as well. There's going to be people looking to do breakout buying. If it rejects from here and then breaks through, what these traders who are trained to do breakout buying or breakout selling is when it breaks through a zone like this, they're going to be buying. They're going to be buying. So in other words, where's their money going to be? Their money is going to be somewhere beneath these equal highs. So in other words, there's going to be money up here too. There's going to be tons of money up here too. And you know, this is one of the holy grails of retail trading. You get a double top, you sell it. And so this is why there's going to be money up here. And then we can look to the right again. We got equal lows this time. So you can see we got equal lows now to the right. And so once again, the same concept. When price returns back to the same area more than 1 time, okay, in this case it's 2 times, this becomes equal lows, and it's the same concept. The retail traders, once again, they're trained to put their stop loss beneath this area over here. And so in other words, there's going to be money down here. There's going to be money down here. When they jump in with their rejection candle and they jump in for the buy, they're going to be putting their stop loss either beneath this low, within you know, the very close of it towards 30 pips, or beneath the previous low, because this is what they're trained to do. And so there's going to be money down here too. And just like there's breakout buyers when price breaks out the top end, there's going to be breakout sellers too. People looking to be sellers beneath lows. There's going to be breakout sellers. And in this case, there's going to be people who are willing to be buying above this high. So there's going to be breakout buys. With these equal highs and equal lows, they do not have to be perfect. As you can see, I've not drawn up perfect. They don't have to come up to the same point to the T exactly, you know, every single time. It can come up to this level. It can just work just a little bit above. You know, these are still equal highs and these are still equal lows. They'll just be called relative equal highs or relative equal lows. So there's not much difference. There's not much difference at all. So here's another example of liquidity again. So whenever you see price consolidating, okay, whenever you see price consolidating, so in other words, consolidation just means that the market is moving sideways. So in other words, price is bouncing between this high and this low and this high and this low and so on and so forth, just constantly going back and forward. Sometimes it expands just a bit higher than the high, and then sometimes it expands just a bit lower than the low, like that, something lower than that as well. It doesn't really matter. It's still consolidation. Price is still moving sideways. So you're going to get liquidity on both sides of the market. So as you can see, I've put the pound sign on both sides. And the reason I've done that is because there's going to be money on both sides of the market. So you have to think about what's actually happening when price is bouncing between this range, when price is bouncing, constantly touching both sides of this range over here. You have to think about what's happening. Traders are looking to buy from the lows and they're looking to sell from the high of the range. They're looking to buy from the low of the range and they're looking to sell from the high of the range. And so once again, once the people are buying from the low, their stop loss is going to be beneath here. When people are selling from the high, their stop loss is going to be above this high. So in other words, there's going to be money on both sides of the market constantly. The more they consolidate, the longer the time they keep price consolidating or keep price moving in a range, the more money they're building up on both sides of the market. And so what else is there? Once again, there's going to be breakout buyers and breakout sellers. There's going to be people or traders who are willing to be buyers above highs. When price breaks out of this consolidation range, they're looking to buy. There's also going to be willing participants who would like to sell when price breaks out of this range. So when it breaks out to the bottom side of this range, they're looking to sell. They're like, hell no. Price is done consolidating for the longest time. They've been consolidating for 3-4 days, let's say 3 days or 2 days, or even if it's an hour. Or if you're using the lower time frames, it could be consolidating for, a few minutes and now be broken out. They're looking to be sellers beneath lows. And once again, their money is normally either on somewhere within this range or on the top side of the range. And so there's going to be money on both sides of the market again. Okay. So whenever you see consolidation and whenever you see them doing this, they're accumulating some kind of orders. They're accumulating orders on both sides of the markets. And, there's normally going to be a manipulation after that. Here's another type of liquidity. Here's another form of liquidity. Everyone knows about this one right here. Whenever you see the market creating higher highs and higher lows and higher highs and higher lows, and it's respecting some kind of trend line, there's going to be liquidity beneath the trend line. This one is known as the liquidity pool. And so all the liquidity pool is this. It's just a pool of stop losses. It's just a pool of stop losses. So in other words, there's tons of stop losses beneath or above or at this area. So in this case, it's going to be a pool of stop losses beneath this trend line. Just like this downtrend, when you get in these lower lows and lower highs and it's respecting some kind of trend line, this is known as a liquidity pool. So once again, there's going to be money above this high. And when I say a liquidity pool, what I mean is this. There's going to be some money beneath every single one of these lows. You can get these being respected for quite some time, and then eventually you see like it dips beneath, and then eventually you see a break of it sometimes, and then eventually price decides to break this trend line and manipulate all the lows. The reason it's doing that is because there's money down there. There's liquidity down there where it's diving into a liquidity pool. There's going to be people who are willing to buy price whenever it touches the trend line, or whenever they get a rejection off of that trend line. They're going to be willing participants to buy. And so what they're most likely going to do, they're going to put their stop loss somewhere between where they entered and the previous low. So in other words, there's going to be money beneath this low over here. And the same thing again, the price pushes up, breaks above the high, runs the money on the top side, runs the money, and eventually what do? They come back down, tap this trend line again, and then they get rejection candle. Cool, it's time to jump in again. They put their stop loss anywhere beneath this low and this one here. And if they really want to be safe, they put the stop loss beneath this low over here. At every single touch of the trend line, there's going to be more money added to the liquidity pool because there's going to be more willing participants to buy. And it's the same thing right here on this downtrend. There's going to be money above all these different highs this time. Because there's lots of stop losses in this area, it becomes a liquidity pool. So in other words, it's just a pool of stop losses. Just imagine a swimming pool and it's not even water, it's just people's stop losses. Basically, that's what a liquidity pool is, right? And so at every single touch of this trend line, and they get a rejection from this trend line, there's going to be money above these highs, all these different highs. And you can get liquidity pools above consolidation because once again, let me quickly go there actually. There's also a liquidity pool above the high and the low of consolidation as well. I just never mentioned it because it's just a build up of stop losses once again. Whenever they tap every single part of this range, there's going to be stop losses placed on each side. There's a pool of money above and beneath the consolidated range. You can find this on any single time frame. It doesn't really matter whether you're on a 1 minute time frame or on a daily time frame. You will find liquidity above and beneath highs. You will also find liquidity above and beneath candles as well. So above and beneath every single candle, there's also liquidity. Why? Because there's people looking to buy and sell throughout the whole day, and so there's going to be liquidity above highs and lows as well. So it doesn't really matter whether you're on a daily time frame, the 1 minute time frame, the 15-minute time frame. It does not matter. There will be liquidity above and beneath the candlestick. So now we're going to go ahead to the charts to identify liquidity. All right, guys, so we're on the charts now and we're looking at Euro USD right now. And so right now, what we're going to be doing is we're going to be identifying liquidity. I'm going to be showing you guys the various types of liquidity that I can see on these charts. The sole purpose of this video, this first part of the series, is just to identify liquidity, just to get your eye seeing what liquidity looks like. You know, there's going to be major liquidity and you're going to find that above daily highs, weekly highs, monthly highs. And then you're going to get the internal liquidity on the lower time frame. So let's just say on the 2-hour time frame, 1 hour time frame, all the way to the minutes and to the seconds as well. You're going to get that internal, that minor liquidity as well. So now let's just look at the charts now. You can see Euro USD. There's going to be liquidity beneath lows. So let me quickly expand this real quick. Let me quickly just, there we go, boom. We're just going to work our way through Euro USD. So like I said, there's going to be liquidity beneath lows and above highs. And so, you know, straight off the bat, you can see, look, there's roughly about relative equal highs. So this high and this high, there's going to be money above this high over here. It's going to be money above the high. And there's also going to be money above all these different highs too. And so when price runs up to a high, but does not take it out, what do? They generate more liquidity on top. This little zone over here, so I'm just going to use arrows for that analysis. This little zone over here, when they never ran the high of this high over here, when they never ran the liquidity, when people saw that, they thought, okay, cool, this must be a very strong zone. This must be it respecting this area. So now we're going to jump into sells and put a stop loss above the high. But look what happens. Before price moves down, as you can see, they run out liquidity first and then they move. Price basically it's created one high, another high, didn't beat the high, generated more liquidity in this area over here, generated more liquidity in this area over here, came up again, did not beat the high again, generated more liquidity up here. They actually created equal highs. So from this high, I'm going to quickly change this to the arrows. So from this high over here to this one over here is technically equal highs. So let me quickly just bring that down a bit. You can see here, okay, technically it's relative equal highs. Like I said, they do not have to be perfect. But before they moved, right, before they moved lower, because this was their intention, as you can see, they ran liquidity to the top side first and then dropped price down. So you have to think about what they did here. So not only they took out the people who were selling at this point, yeah, they also activated the breakout buyers, the people who are willing to be buyers above this high. Then they dragged price against them and stopped them out. So the people willing to do breakout buying, where was their stop loss? Somewhere within this zone, from this low to the actual zone itself. Look where price ran to. It ran all the way down. It made sure it took all the liquidity. It didn't leave no one out. It took all the money. So it ran the money to the bottom side. So not only the sellers were taken out, the breakout buyers were taken out too. There's money on both sides of the market. Both sides of the market. Look what happens here. They trade lower beneath the low. Look at this. Look where my cursor is. You can see they trade beneath it. Equal lows. Once again, this is just an example of equal lows right here. Equal lows from this low here to this low here is equal lows. I'm gonna move my cursor to the right so you guys can see it. Just look at the line. It's equal lows right here. Once again, just mark it up right now. Equal lows, so you can see it. Look here, equal lows. You can see it now. Equal lows right here, and that was equal highs. But look what they did. When price moved away from the zone, once again, the people who do double bottom trading, they're going to be looking to buy. They're going to be looking to buy. And there's going to be breakout sellers down here too. So there's going to be sell side liquidity beneath here. So people who are willing to be sellers beneath these lows or beneath old lows. One thing I always tell my mentees is you don't ever want to be a buyer above an old high, and you never want to be a seller beneath an old low. Okay, you don't want to be doing that. You don't want to be playing yourself. That's what retail traders do. If you trade basic concepts, no. Look what happens. They run them out again. Run them out first and then they move higher. So now you're getting a picture of what happens. They run liquidity and then move. They run liquidity and then move. There's so much in this, guys. There's so much in this. Just a quick interruption in the video. If you are getting value from this video, definitely subscribe to the channel. Also, don't forget to smash that thumbs up button. Let's try and get this video to 400 likes. So check this out here. This is consolidation. We're on a 4-hour time frame right now. If I showed you this on a much lower time frame, you will see this price bouncing between this range over here, bouncing between this range. But look what happens. There's going to be money on both sides of the market during consolidation. There's going to be a liquidity pool beneath and a liquidity pool above. And look what happens. They run out the lows and then they run out the highs. What have they done? They run out both sides of the market again. Liquidity is being taken on both sides of the market. Both sides of the market. So now you're seeing examples of consolidation as well. And so now let's move on to the right. There's so much in this. You can see constantly before they move, there's some kind of, grabbing of liquidity first and then going. This low over here, what does this low look like to you? So remember I did tell you guys, I told you it doesn't have to look exactly perfect. It doesn't have to look perfect. This again is relative equal lows. So in other words, they came down to this area, they came down to again, never run the liquidity. In other words, what did they do? They generated more liquidity. They generated more stop losses down here. So in other words, there's more money down here. But don't think they forgot about that. This is why I always tell people you trade towards the money, because price is drawn to the money. You're going to lose some trades here and there as well, but that's just part of the game. It's part of Forex. And also just to add to this, look at this. Look at this low over here. So let me quickly move this back to the arrow again. Look at this low and look at the high. There's going to be money above and beneath these candlesticks. Above and beneath this candlesticks. So when this candlestick ran beneath that one, it ran out the liquidity, the bottom side liquidity of this candlestick. When this candlestick traded beneath this one, it ran out liquidity beneath this candlestick. And then look at that. Then there's liquidity above these candlesticks too. So when they traded back higher, they ran out the top side of that candlestick. So there's liquidity all over the markets, on both sides, in the form of buy side liquidity and sell side liquidity. So now let's move on. So what else do we see here on this chart here? We see a trend line. We see a trend line being respected. This is a trend line. This is a retail trend line. Once again, whenever it taps the trend line, it doesn't break above it, it respects it. And so in other words, what retail traders are taught to do is to sell price down. They're taught to sell. And so just in this little case here, when they did sell price down, you can see they sold it and they didn't start moving higher until they had run out the liquidity. They ran liquidity, consolidated for a little bit, and then they moved. And this candlestick here, just being very cheeky, this one here, yeah, this one right here, the low of it comes in at 1.17719. This one comes in at 1.17721. So in other words, what happened? They ran lower than this candlestick here, tagged in the breakout sellers, and then did them dirty. Took them the other way in all kinds of drawdown. Once again, this is what happens. They take liquidity and then they move. And so just back to this trend line now. Like I said, there's going to be a liquidity pool above here. A liquidity pool. Because whenever it taps this trend line, people who sold from here put their stop loss above these highs. People who sold from here put their stop loss anywhere between this area here and this high, and so on and so forth. And so there's going to be money up here. There's going to be a whole pool of money up here. And look what happened. They teased the liquidity pool down here. They traded above into it, stopped out anyone who was trying to sell early, stopped out anyone above this high, as you can see, this high here. Because everyone who was selling would have put the stop loss above this high. And so they traded above, it ran out all the money that was resting above here, and then it moved lower. This was just a little tease. Because there's still money above all these different highs. So now let's look at the bottom side too, because there's going to be money on both sides of the market. So once again, you can see here, we have like relative equal lows. They trade beneath it to run out the people who were buying early. And not only that, look at this again, the people who did breakout buying, so anyone who was looking to sell beneath this wick over here, they got tagged in and then they got dragged back into the range. Once again, it's just suffering, just being taken left, right, and center. Once again, the people who's thought, okay, cool, this surely is the low. This has to be the low. If it breaks this low right now, we're going to be selling because we're breakout sellers. They trade just beneath the low once again, activate the sellers, and then drag them back into the range. And then run them out even more. Do you understand? So liquidity is just being taken left, right, and center. Liquidity pool. So this is the tease, yeah. And eventually, when market flow switched from a downtrend to an uptrend, then they went to attack the buy side liquidity, the money on the top side. And look what they did. They ran out every single person who was selling until this high over here. and then they consolidated for a little bit. They did one more liquidity run above the high, above these highs, and then they started dropping down. Then they mitigated this candlestick a few times and dropped. But we're not here to talk about that right now. But what I'm trying to tell you guys is that, look, they've run out liquidity. They'll be running out liquidity. And you're going to find this in every single time frame. Every single time frame. You have to know where the money is and how they're trading towards it. And if you can identify what money they're going for and get in line with that, you're most likely to win your trade. People have the right direction, they're just in at the wrong time. Do you understand? And so this is why it's so important for them to identify liquidity and know where the money is in the markets and then trade accordingly. That's the main thing. Let's keep it moving because we're not done yet. There's this money in the markets. What does this look like to you? When price was doing this, what was actually happening over here? What was actually happening over here? Price was moving sideways. Although they were manipulating the lows and taking out the sell side liquidity, overall they were moving sideways. And so what happens? Price then comes to run out liquidity again, these lows. Because there's going to be money beneath these lows too. There's going to be an accumulation of orders on both sides. And so as you can see, they wicked straight up, they took the money to the top side, and then they traded into the liquidity pool to the max. Yeah, they took everything above this liquidity pool. Then they dropped price down, ran out the sell side liquidity, as you can see right here. Let's move on to the right again because you're going to see more. There's going to be constant examples. So let's look at this low over here. Let's look at this low right here. So not only do you see like some kind of trend forming here, some kind of trend line. So once again, you're going to see a liquidity pool. There's going to be stop losses above these highs. There's a trend line here, a retail trend line. So there's going to be money above these highs too. But then look at this low over here. Let's quickly mark up this low. So this low comes in at, the low of it comes in at 1.16658. This one comes in at 1.16641. So what happened before they moved? They ran the lows. They activated the breakout sellers first and then they moved. It's so cheeky. Look, they can even do it by 1 pip. 1 pip. Yeah? 1 pip. Whatever the low, I don't know if I've drawn it correct, but they can even do it by 1 pip. They just traded just beneath it before moving because this was like equal lows. Yeah, so I just didn't draw it up, but this is just equal lows as you can see. So we have a low here and it traded right to this low here. Equal lows again. They tapped just beneath the equal lows and then they move. After they tap the equal lows, as you can see down here, after they tap the equal lows, then you get the push up to violate every single one of these highs. Every single one of these highs. Every single one of these highs. Let's look at this. Let's just bring a line from here, drag it straight across like that. Look at this. Look where they started to consolidate from. They didn't stop until they ran out the high because you're going to get liquidity at swing points also. Yeah. This is where they decided to consolidate right now after they tapped the high. And look at this. This is where price is now looking like it wants to slow down. Now it's broken this high. Okay, broken this high. Look what it did here. Ran the high, then it began to slow down and it just trickled higher. As you can see, another big push. But before the big push, what came? These lows. Ran the lows, then the push. Ran the lows and then the push. Right, to take out the liquidity on the top side. So guys, there's liquidity throughout the whole market. It's non-stop. Everywhere, okay? It's non-stop, And so this is why part 2 is going to be so vitally important because I'm going to be showing you guys how to trade towards the money, how to trade towards liquidity. So this is liquidity in a nutshell. So beginners all the way through to advanced could understand how to identify liquidity. Now you've watched this, I want you guys to rewatch this video and drop a comment down below with whether this video actually helped you guys. This was the biggest game changer for me. And this is why this is my #1 Forex tip is you always trade towards the money because when you trade towards the money, you win more of your trades. That's going to be the video done. Hopefully you guys liked the video. This is just the part 1. There will be a part 2 series on this as well. Let's try and get 400 likes on this video. The moment we get 400 likes, I know that you guys are ready for the next video on liquidity. Also family, if you want my mentorship, hit me up on Instagram. My Instagram is at MHU_FX. And then yeah, just drop me a DM. Just let me know that you want mentorship and then we can get to work on that. Other than that guys, subscribe to the channel. Let's get this channel to 50,000 subscribers. Enjoy the rest of your day and peace.